What is up? Welcome back to another video. In this video, I'm going to be talking about um, fair value gaps, but most importantly, I'm going to be telling you which fair value gaps you want to use and which inversion fair value gaps you want to use. So I have already taught you guys what a fair value gap is, but just to rerun your mind very quickly, you just have to find 3 candles in the market that have a gap from the first and the third candle. So as you can see here, we have a fair value gap here, and we have a fair value gap here. So in the market, there are lots of fair value gaps, and some of you might be struggling on which fair value gaps you want to use and which fair value gaps you need to avoid. So hopefully by the end of this video, you will have a clear understanding about which fair value gaps you want to use and which inversion fair value gaps to use and which not to use. So let's jump straight into it. So if we're looking at this bit of price action right here, let's not worry about determining the bias or thinking about if the fair value gap is good or not to take. Let's just ignore that and let's just focus on how we find the best fair value gap to use. So if we can look at this price, so 9:30, this is where the price opens. So after 9:30, as you can see, we got a lot more volatile in the market, and we have a fair value gap here, and we have a fair value gap here. Now, let's say we come take the replay back, and the price action is here. Let's say you want to take a long position right now in the market. We have these 2 5-minute fair value gaps. So as we know from the first fair value gap video, what price most likely wants to do is come back and fill these fair value gaps. So as you can see, we have 2 fair value gaps here. So if I was in this situation, what I would do is I would just completely ignore this top fair value gap there, and I would only focus on this bottom fair value gap here, because even if we were to fill this fair value gap, so even if we was to fill this fair value gap here, I think that is irrelevant, as then we have this fair value gap here. So let's say we ignore this bottom fair value gap and we have this fair value gap right here, and price taps into this fair value gap. I would not take a long position right here because the risk reward wouldn't be as good, and we have this fair value gap below that is most likely going to be tapped into. So what I'm trying to say is, if you have 2 fair value gaps that are extremely close to each other, focus on the bottom fair value gap, or if we are bearish, focus on the top fair value gap. So in this case, we are bullish, so I would only be focusing on this bottom fair value gap right here. And then if we carry on playing the price, we get this inversion fair value gap. So this is a lot easier. So as you can see, we have this inversion fair value gap right here, and as you can see, in this little leg down right here and this little move down right here, we don't have any other bearish fair value gaps. So in this situation, we would obviously mark out this fair value gap, and we would only have to worry about this fair value gap being used as an inverse because there is no other fair value gaps. So we then play at the price action, and here, as you can see, we have many fair value gaps. We have fair value gap here, we have fair value gap here, we have a fair value gap here. So in this situation, you might be wondering, okay, if price was to retrace, what fair value gap would you take? Now this is a bit different because, as you can see right here, I have not taught this yet, but this is what you call a bullish breaker block. Now, yeah, bullish breaker block is once we create a new swing high and then we come down, we get a little retracement, and then we come back up breaking the most recent swing high, then that would be where our bullish breaker would be. But and there is also an order block here. So what I'm basically trying to tell you guys is there is multiple PD arrays in this certain area. So if price was to come back down, the fair value gap that I would be focusing on here would be this, mainly this fair value gap right here. So if price action was to come down, like this, and then get a retracement back to the long side, I would focus on this fair value gap here, just because we have this bullish breaker. So if we got a confirmation setup here, I would enter into a position here, and my stop loss would be below this fair value gap, because price action could always come into this fair value gap. Now, every fair value gap in the market doesn't have to get filled all of the time. Price action could come down and only fill this fair value gap and not come into this fair value gap as it does. So just note that when you are looking at fair value gaps in the market. So now let's just go to another day. So this is Thursday. So now let's talk about bearish fair value gaps. As you can see, there are multiple bearish fair value gaps here. So let's say we are looking at this price action. We have this move down, and then price is coming up to retrace into this bearish fair value gap. Now, would I take this fair value gap in this down leg? Now, if you have a look in this down leg right now, let's say we was going short. Don't worry about if the short is right or not. That's not what we're trying to achieve in this moment. I'm just trying to teach you guys which fair value gaps you should be taking. So once the price action is like this, obviously we would only be taking this fair value gap, as there is no other fair value gaps in this leg. But if we go down into, let's say, the 2-minute time frame, let's mark out this fair value gap. Let's go down to the 2-minute time frame. As you can see, there is multiple fair value gaps here. So let's say I was looking at this chart. Let's even go to the 1 minute. Let's say I was looking at this chart on the 1-minute time frame, and I was going to take a short position from here. So I said to myself, I want to take a short position from somewhere around here. What would I do? So I would realize that, oh, there are lots of fair value gaps here. So I'm not going to just gamble and hope that the fair value gap I pick is the one that I'm going to take. Firstly, what I would do is I would go to higher time frames. So I would go to the 2-minute time frame, and I would see if I can just get one clean fair value gap instead of multiple fair value gaps. So as you can see on the 2-minute time frame, there is still 2 fair value gaps. So I wouldn't be interested in this. Then what I would do is I'd go to the 3-minute time frame. As you can see, the 3-minute time frame also still has the 2 fair value gaps right here and here. So I would not be looking to take any trades off here. Then if we go to the 4-minute, we only have one fair value gap. So then that's what I would use. I would focus on this fair value gap right here. And and as you can see, that worked, but that's not the point of this video. We're just finding which fair value gaps to use. So here is another example. As you can see, we have this price action here, and we get a fair value gap created here. Now on the 5-minute, there is only one fair value gap. So obviously we would only take this fair value gap. But let's say we go to a different time frame, for example, the 2-minute right here, we have a fair value gap here. We have a fair value gap here. And we have fair value gaps here. So as you can see, there is clearly lots of fair value gaps. Now, what I would do is I would normally start on the 1-minute time frame, and then I'd work my way up. I wouldn't start on the high time frame and work myself down when I'm working between the 1 and 5-minute, just because a 5-minute fair value gap is a lot more important to me than a 1-minute fair value gap is. So as you can see, on the 1-minute we have lots of fair value gaps. On the 2-minute we have lots of fair value gaps. 3-minute we have lots of fair value gaps. 4 minute, we also have lots of fair value gaps. But on the 5 minute, we only have this one fair value gap. We don't have any other fair value gaps. So what would be the fair value gap that would be most interested? It would only be this fair value gap here. Now, in a real scenario, I would not take this trade just because, as we can see on the lower time frame, we do have a lot of other fair value gaps that hasn't been tapped into, but you can do your own back testing on that and just see if that would be part of your strategy or not. But personally, if there is multiple different fair value gaps like this above a 5 minute fair value gap and the price is volatile like this, I just would not be confident in taking this, although it does look like a nice 2022 model. So yeah, I hope this video helped. All basically you need to know is if you start on the 1 minute time frame and there are multiple fair value gaps, what you can do is just work your way up the time frame and see if there is less and less fair value gaps that you have to choose from basically. And if there is more than one fair value gap on the 1 minute time frame, then just choose the one that is closest to the bottom or the one that has more PD arrays within the fair value gaps. So I hope this video helps. Make sure to leave a like and subscribe.